Today, crypto markets struggle to break a 4-day losing streak. Tether takes steps to make its stablecoin more transparent. And a new study says up to 25% of Coinbase listings show signs of insider trading.
Just some breaking news here off the top. FDIC issuing cease and desist letters to 5 crypto companies. Jared Blickery is watching the action in the crypto stocks, and it says it all right there on the heat map. A lot of red.
The cryptocurrency market has from its inception been at loggerheads with governments around the world. Most governments had never been comfortable with the power blockchain technology gives to digital assets, such as the cryptocurrencies. But thanks to the centralized crypto exchanges, the government has the desired chokehold it needs to regulate cryptocurrencies through proxy. Coinbase recently became the subject of discussion after some insider leak on listed crypto assets that should have been listed as securities, but were not. There's a real risk of losing it all if you happen to be holding a crypto asset operating outside the SEC's regulations. Welcome again to the Wealth Supremacy channel, where we bring you the latest on the economy, cryptocurrencies, and the equity market. You don't want to miss any of our videos. Subscribe now and turn on the notification bell, so you're never late to the latest investment news. In this episode, Cathie Wood, who was one of the largest investors in Coinbase, would be revealing details every crypto investor should know. She also reveals that inflation should not be the focus for investors now, but deflation. Her revelations are shocking, and there is a need to pay serious attention to what she has to say.
Last time I saw you on Bloomberg TV, you were talking with Ed Ludlow out of Bentonville, Arkansas, and you said to him, we have a real inventory problem. Walmart and Target had just been out with numbers that were concerning in terms of the buildup of product, and you said deflation is more of a concern than inflation. Do you still think that after the big prints that we've seen, and we're still expecting, for example, 8.7% headline CPI on Wednesday?
Yes, I still think that because the evidence is piling up. Now, the CPI and in some measure, the PPI, both of those are lagging indicators. The Fed is driving policy off of lagging indicators. If I look at Dr. Copper, the commodity with the PhD, it had been trading for a year in the $4 to $5 per pound range. It's now down to $3.50. It's had a decisive break. And if you look at how that's going to feed into the indexes, it'll feed in slowly, to be sure. But just month over month, copper is down roughly 20%, and year over year, it's down roughly 20%. Mm-hmm. So that's the activity side of things. If you look at the real inflation gauge out there, it's gold. Gold prices peaked in August of 2020, 2 years ago. And we've been in a trading range, to be sure. We're at the low end of that trading range now. Right. If the Fed continues to tighten, we believe the dollar will turn back up and these commodities will continue to fall.
The big news is inflation. But how big is the inflation? Key indexes to determine price performance of commodities and services are the Consumer Price Index, CPI, and the Producer Price Index, PPI. Let us look at the charts. We can see that in 2022, the CPI indicates that for all commodities there's an 8.5% price increase, but when we remove food and energy, the increase is adjusted to 5.9%. This reveals that food and energy alone has about 30% pull on the inflation index. Because of this, the price performance of a lot of tradable commodities, such as gold and copper, are being ignored. The 2022 PPI index shows that in the past month, tradable commodities have actually moved almost 2 points in the negative, showing that commodities are actually experiencing a deflation and not inflation. The natural reaction of most investors is to buy gold when the economy is underperforming. But this time, we see that buying gold or investing in the commodities market would only mean losing money. This is why Cathie thinks we're focusing on the wrong indexes, and this would make people lose even more money.
If you believe we're in a recession and you believe the Fed is going to go on a sort of hike-raising path, why not go to cash? Why stick into the fund? It's an actively managed ETF. You can do whatever you want, and I guess some people wonder why not have more of a cash reserve?
We are going to be 100% invested in innovation. That's who we are. This is what we're paid to do. This is what we say we are. And we think that innovation is going to be a critical allocation in the years ahead as the world moves rapidly. And it tends to, innovation tends to gain traction during tough times. Innovation solves problems. We have so many problems right now. We've got the supply chain problems, which we're still hearing about. We've got energy and food prices up because of the war, really hurting consumer purchasing power. And so I think better, cheaper, faster, more productive, more efficient, more creative is going to win. That's what innovation is. So we think most asset allocators are short innovation. And I don't mean NASDAQ 100. We don't think that's truly disruptive innovation.
In a period when most investment managers and traders are holding their funds in the dollar to mitigate against declining valuations of equities, Cathie differs. She believes this is ripe time to stake money on equities of companies that are developing disruptive innovations aimed at addressing the myriad of challenges affecting consumers. Food and energy crises have only worsened because of the war. This actually is a huge market void that can be capitalized on with innovative solutions. This is where Cathie would rather put her money, and this makes a lot of sense. We've seen companies such as Zoom take advantage of a crisis to come to prominence. The key is looking for stocks of companies that have a huge growth margin. She does not believe stocks such as the NASDAQ 100 have such growth potential.
And Cathie, I got to ask you about crypto. ARKW holds GBTC and Coin. So you sold a little Coin. I want to get your take on why you sold Coin and what your feelings about that stock is, and also GBTC. Obviously, this is a way to get exposure to Bitcoin, but it's been in a severe discount. Why not use, say, BitO or even MicroStrategy, which is a proxy for Bitcoin?
Okay, so Coinbase, why did we sell some? On the day that the insider trading was announced, that's not why we sold it. Actually, it was Coinbase who surfaced or exposed what was going on there for the SEC. But the SEC did weigh in and say, we think that at least 9 securities, I think it was nine of the crypto assets on Coinbase's platform are securities. So there was just a little bit more uncertainty. Okay, how many of these will they have to delist if they decide not to register with the SEC, or if they register with the SEC? How will that change their business models?
In July 2022, Cathie Wood made headlines when her ARK investment management firm dumped a mind-blowing $75 million worth of Coinbase shares. This move was necessitated because the crypto exchange was under investigation for trading securities disguised as cryptocurrencies. Cathie reveals that as much as 9 of these illegal listings were found, and there is a possibility that many more will be flagged by the SEC. Binance, another major crypto exchange, responded by delisting a cryptocurrency that was previously listed on their own exchange too. Could this mean these exchanges are aware they're illegally listing crypto assets? How many crypto assets being traded today could possibly fall under the SEC's hammer in the nearest future? What would be the fate of those who have purchased such cryptocurrencies? These are just a few of the many cogent questions we should be asking. We're interested in your opinion. What do you think? And don't forget to like and subscribe if you haven't already.